So first, I'd like to thank everybody for coming this afternoon. To choose to come to this session directly after lunch definitely takes some courage. And hopefully after the next 45 minutes or so, your lunch will still be intact. When we do webinars on this topic, we often start off talking about polls. So how's everybody doing? How's everybody feel about their preparations? So I'm just curious from this group how everybody thinks they're prepared for the October 3rd changes that are literally right around the corner. Everybody feel good? Piece of cake. Well, when we're done, I'll share with you some of the words that people on the panelists at the MBA used in DC this past weekend, where I was for 3 days at the MBA Regulatory and Compliance webinar. And in the last session, they had 25 or so of the panelists in kind of a round table addressing the room of 500, and everybody had one word. I'm going to save that to the end. We're going to go through this deck relatively quickly because of time constraints. We will try to get to some questions at the end. I'm not going to address every bit on the slide because we're hoping that you guys have a pretty good foundation, and then we'll just take it from there. So once again, I'm Phil Shild from REMN Wholesale and Hobridge Financial Services. And if you don't know, October 3rd is D-Day for TRID. And the first thing I'll mention from DC is that the CFPB wants us to refer to this as the know before you owe rule. Okay, not TRID. They think TRID is kind of harsh, and the entire initiative really about the integrated disclosures is for consumers to know before they owe. And I think that that's a mouthful, so we're going to keep calling it TRID and go from there. Obviously, it was supposed to be initiated back in August, and then there was the delay. I think that while there were technical reasons while it was delayed, it was obvious that industry was not prepared, and I can look back and see that if we were effective on August 1st, we would not have been ready, and I don't think anybody would have been. So God bless, here we are coming up on October 3rd, and I think that there's still a lot of questions and concerns. And what we're gonna do is just talk about some of the basics, and then we'll deal with some of those questions and concerns. So real quick, TRID only applies to closed-end consumer credit, properties that are secured by real property. Doesn't include home equity lines, reverses, and so forth. And depending on your business model, you're going to need to be able to potentially have transactions that are going to be under TRID, as well as those that are still under the current rules, RESPA and TILA. Preparing for today. Maybe tomorrow, maybe the next 2 weeks, the next 3 weeks, the next 3 months. I don't think preparation is one day for this. I think it's going to take a while. And I think one of the things we need to do as an industry is be prepared for the fact that day one is not is only the beginning. This is going to continue for a while. So starting with the beginning, definition of an application has changed. Up to this point, since RESPA, we had 7 items, okay? For most people, the 7th item was a catch-all item where the lender could define what an application meant. Now we go to a uniform definition for everybody. There's implications. It seems simple. 6 items, everybody, it's the same, it's an application. But it's really not that simple, and we'll touch on some of that as we go through. Remembering that applications received prior to October 2nd will be on the old disclosures. They'll maintain the old disclosures throughout the life of the transaction. So a pre-application will have a GFE and a TIL through the life. If you lock, if you redisclose, you're going to always issue the corresponding GFE and TIL for the life of that transaction until it ultimately closes with a HUD-1. The TRID applications will similarly start with a loan estimate, and they will close with a CD. So you're not going to have interactions between the 2 sets of disclosures. But transactionally, you're going to need to keep track of it. And we'll talk about that as mentioned here. How does your LOS track it? Does your LOS track 6 items? Some do. I know for sure. How are you going to do it when it triggers the 6 items? Do you get an alert? Do you get a stop? Does it tell your processor that they have to issue a loan estimate? What happens in your system? Well, also, who does today your disclosing? Is it an MLO or is it a processor? Do you want an MLO to have the authority and really the responsibility of issuing that early disclosure? And those questions may not be answered yet, and I think that as we progress, people are going to kind of have to deal with those things. Mentioned here also about online applications. If your online application portal today takes a full application, you're disclosing on every single loan once you hit 6 items, intentionally or not. It's triggered. So some people have modified their online application portals so that maybe you can only put in 5 items. You can't put in a 6th item. Lenders are figuring out which is the 6th item that they're okay holding back. Is it, the income? Is it the, the estimated property value and so forth, so that they don't unintentionally trigger the, the requirements to issue an early disclosure. And then who will be responsible for communicating old versus new? When you're dealing with a settlement on an old loan with a HUD-1, where the settlement agent's preparing the HUD one versus a new with a CD where in most cases, as far as we know, the lender will be preparing the CD. So how is that communication going to be established? You know, how early in the transaction is it going to be established? And how are you going to communicate with your settlement agents in regard to that? Pre-application considerations, very briefly. The rule specifically allows for the issuance of a closing cost worksheet. And if we think about where we are today, and when the 2010 rules came out, most people continued to use the old GFE as an upfront sort of a worksheet for people because they found it easier to use and more explicit information. So this is going to have to change again because there are certain requirements about issuing an upfront fee worksheet prior to application. And this stuff is relatively basic. I know that some of the LOSs will have this as a standard form that you can use and that you can have you know, a universal closing cost worksheet to be used for your MLOs upfront. But there are some things that go along with that, which is that A, if your LOS doesn't have it, how are you going to handle it? You know, also, if your MLOs have their own versions, branded, their picture, their NMLS, whatever other things they happen to have on it, how are you going to convert those to being compliant with the new rules, if you are going to allow that to continue, you know, and so forth. So once again, these are items to think about, not necessarily solutions for all you, but things for you to think about as you're preparing. Also, do you offer products not covered by TRID, and will you need multiple versions of an upfront closing cost worksheet? Okay, it's an absolute necessary tool. The question is, how are you going to actually, you know, put that into your operation? Existing leads and you know, another pre-application consideration that has been talked about extensively for the last 6 months in a lot of the training sessions, webinars, and so forth. And you know, what do you do for your leads, call them, that have 6 items? And basically, what the rule says is that they do not automatically become TRID applications on October 3rd if you have the 6 items. And there's a lot of small print there, which I recommend that you read because it's a simple statement. But you know, we're grappling with the questions in the retail channels about, okay, well, it's not LE, you know, you don't have to disclose an LE on day 1, but what happens when you get that next item? What do you disclose? You disclose under the old regime, GFEs and TILs, or you disclose under the new regime, LEs. And how long do you customarily let your MLOs have pipelines of leads? You know, how many thousands of loans you have potentially sitting there that are just, maybe they haven't talked to the borrower in years, or who knows. You know, what is however you organize it in your LOS or your contact management system, you know, what's the aging of that population? And what are you gonna do? I mean, it's inconceivable, it means to think about now that a lead that's a year old going into this, you let go for another year, and then you're gonna think about disclosing it with a GFE and a TIL in 2016. It's just impractical. So it's an ugly discussion to have with sales about, you know, having to pare down the pipeline of leads because MLOs don't want to let go of that. We know that. You know, that may be the next deal that comes in, but you have to be practical about it. So that's one of those things here that's mentioning about defining old versus new in LOS. You know, a number of lenders decided that they were going to change their application definition early. 6 items today, disclose them all now with GFEs and TILs and get them out there and just deal with it as they go. That was one decision, and I think depending on the size of that lead population, whether or not that's practical or not for your particular organization. And then once again, you know, when you're talking about wholesale, you know, how are other lenders dealing with this? You know, how do they expect to see you disclose those loans early, depending on when that, you know, what the application date was and what it looked like and so forth. Pre-qualifications and pre-approvals. There's some comments here about that the Bureau felt that they weren't going to necessarily be changed too much. I think if you think about it, there's definitely changes to the process. You know, pre-quals, probably not so much. I mean, if you're talking about a generic pre-qualification, maybe not property specific, but just something that somebody can go out there and use, we don't expect much change here. Once again, unless you trip 6 items in your process for doing a pre-qual. If you get that 6th item, then now you have to also disclose the loan estimate along the way when you're doing your pre-qual. There's this, you know, the rule basically says that you can't require verifying information in advance of issuing the loan estimate. You can't require it, but you can request it. You know, so there's absolute slippery slope of what's requiring versus requesting and who's handling that and so forth. So once again, on its face, it's a relatively simple thing. You know, these aren't changed too much, but in practice, I think it's going to be another area because this is mostly in the, you know, in the hands of the MLO as to how this is going to be how this is going to be handled. As I mentioned before, How does the application definition have, what impact does it have on your LOS folder and or pipeline structures? If you issue property-specific anythings, whether it's a property-specific pre-approval and you have 6 items, along with that, or when you get the 6 items, you're going to have to issue the loan estimate. I would guess it's not most practice today to do that. You're not issuing necessarily a GFE and a TIL when you're doing a pre-approval. But if you have the 6 items, and if you think about it, it's impossible to do a pre-approval without the 6 items unless you leave off the property address. Okay, but then what value does it have if you're a purchase shop and the market dictates that you need, the sellers want or builders want a pre-approval with a property address? You're going to be issuing a loan estimate when you do that. Not that there's anything bad, it's just different. So once again, more things to think about. I'm going to change the discussion a little bit and talk about the loan estimate, some other upfront considerations, and lender-paid compensation. Okay? Lender-paid compensation cannot be included on the loan estimate. Okay? Many think that's a good thing. Okay, it evens the playing field, brokers versus bankers, people who are secondary market participants who don't disclose, their gain on sale or, their secondary market, whatever it happens to be, they don't have to disclose it, so now brokers don't have to disclose their lender-paid comp. So from a standpoint of disclosing that part, it's probably simpler, but brokers still need to get paid under Dodd-Frank rules. They still have to have a compensation bucket or a tranche, however that particular wholesaler deals with it, and that still goes to the life of the transaction. TRID doesn't change any of that. So today, when we learned, since 2010 how to set up, the GFE, block 1, adjusted origination, all that stuff, the LE doesn't have any of it. It's gone. You're just dealing with basically your origination charges. How are you going to keep track of your lender-paid comp? Making sure that it's right from the time that you lock or submit your loan. How are your lenders going to deal with that? Is it going to be done in a separate certification, a different place? Because the LE doesn't have it. We know that for certain. So once again, this is a question of how this is being done. How do you know today that your MLO is pricing the loan correctly based on the bucket that you have with your particular lender? The LE was not going to help that at all. At least today with a GFE, you can do the math and you can see whether or not your ultimate compensation, your origination charge, or however it's being done, and the credit for interest rate chosen is right based on what you expect to make on a loan. So while on one hand, the LPC removal helps, on the other hand, it makes it a little bit more complicated. So once again, things to think about there. I will also mention here that there's no examples anywhere in the CFE literature that deal with wholesale specifically, none whatsoever. This is an example that, a doctored up version of what the closing disclosure will look like with the lender-paid compensation in the cost section as an other fee. But it doesn't exist on the CFE website or anywhere else. Our understanding is this is the way LOS will operate, and that's what you'll see on a CD. But once again, you're going to have to, once again, work with your lenders and figure that out. We're hoping that this doesn't unintentionally end up having a situation where brokers aren't making the money that they expected. But once again, that's something that the broker shops are going to have to figure out how to keep track of these things on a transactional basis. Going back to application for a second, TRID did not alter the definition of application under HMDA and ECOA. So the 6-item definition is very specific, and it's just for the trigger of issuing an early disclosure, a loan estimate. But it doesn't change ECOA, Reg B, the process that you use or the lender uses to determine whether or not a borrower is creditworthy, whether or not it's HMDA reportable under Reg C. And if you think about those things, having a 6-item definition for the other 2 regimes doesn't really make sense. At least to me, it doesn't make sense. So you're going to have multiple definitions of applications, and how does your LOS track that? What is the lender, if you're a lender, how are you going to deal with that if you have to report HMDA versus when you have to decision your loans for Reg B purposes? And once again, a lot of the stuff, facially, when you think about it, it's simple, it's 6 items, but when you start getting into the weeds with it, it's much more complicated. And there are a lot of operational implications. And I will tell you, my first, DC tidbit, I probably was in 8 hours of sessions on TRID. There were as many questions today as there were last year at the same time, a year later, when it comes to this stuff. Some things have been answered, but there's a lot of questions still. That's why, they had at least 4 sessions, including 4 hours the first day devoted to it. And there were, I think, 900 people registered for that conference. So a lot of people down in DC trying to figure out literally less than 2 weeks in advance of, how to deal with this stuff. And I will also say that A lot of the panels had representatives from the CFPB, and they did not say much. So if there's anybody from the Bureau here, please identify yourself. Anybody? No. They did not talk much at all. Mostly talk was from industry folks and the regulatory firms in DC. But the CFPB, while represented on the TRID sessions, really didn't say much at all. So anyway, once again, thought process for dealing with application across the other regimes. And that's what this also talks about. And really at the end, how is your LOS distinguishing a TRID application versus an ECOA application versus a HMDA application? Is it? Or do you have to do that yourself? Do you have to define that yourself? Does your system track 6 items? How about those other implications regarding pipeline management and so forth? A couple other considerations. The TRID disclosures do not document compliance with QM points and fees. Okay, so January of 14, we all got into the QM world, QM points and fees, 3%, and so forth. TRID doesn't alter it, but it also doesn't help with it. Because the origination section of the loan estimate is very specific as to what goes in there, and points that are there can only be used for points that are used to lower the interest rate, not necessarily bona fide points or QM points, but points in general. You got to figure out separately, from the loan estimate, whether or not, the points that are being used are being charged and being counted for QM purposes. So once again, there's a distinction here that with some simplicity there comes other parts of the rule that cause other complications. The creditor is responsible for tracking finance charges and points and fees off sheet. So what does off sheet mean? Does that mean LOS? Does that mean on a worksheet? If you look at the loan estimate, there's no indication anywhere of what a finance charge is. And while APR is diminished under the rule, it's kind of in the back of the forms and not so important anymore. You still got to calculate it. You still got to do rate spread tests. You still got to do other types of tests that determine the APR. But if you look at the loan estimate, which if you remember is a combination of the GFE and the TIL, no idea what a finance charge is looking at that form. So LOS dependent indications there as well. So like I said, what does off sheet really mean? Lender practice will vary. And that may impact transactional workflow. You don't want to be in a situation where you don't know what your APR looks like and so forth till the very end, at which point then you're scrambling at the end, and that's going to cause other problems, as well as just learning to deal with the new forms as well. So it says, while the creditor may be responsible for QM points and fees tests, it has a direct impact on the broker, obviously because of lender paid compensation being included in QM points and fees tests and so forth. So a couple of processing and underwriting considerations. TRID disclosures do not specifically address underwriting guidelines, but you have to take a look at the disclosures, especially, the cash to close sections, the sections when we're dealing with down payment and deposit, seller credits, funds paid for the borrower, lender credits, all those areas where you'll see a corresponding spot on your 1003 transaction details, you have corresponding spots on the LE. But I know at least certain LOSs, they're different fields. So you're potentially in a situation where you're talking about having to key that in 2 different places, which causes, potential, errors, issues, and things like that. So there's some holes there as far as dealing with the transactional cost to close, and so forth. Look at the process for how contract addendums that affect these items are handled and institute procedures for swift and specific communication to lender. Dealing with a change to a seller credit for closing costs at the end, it's going to, potentially going to hang some things up there. Other types of things that you have to think about today that are done really at the end of the transaction. The lovely one we talk about with underwriting is, how does this impact DU? There's a lot of fudging going on, to get the DU information to get to DU correctly, okay, from your LOS to DU. Happens all the time, okay, your cash to close, your other things like that, where the underwriters every day have figured out, in the process have figured out ways to get it so that you're sending information, to the portal, through DU correctly, so that it runs, but it's not necessarily what the reality is and what's coming on those forms. And we're still trying to figure out, how does that impact the other forms, the LE, the CD, 1003, and ultimately the information that's traveling to DU. Some have suggested sending out pre-closing instructions. Maybe some folks do it already, but setting the stage, letting the folks in the transaction know the differences that are going to be occurring. If you've closed on a loan prior to this versus a future event, things are going to be different. And if you're a first-time home buyer, you don't know. You're going to rely a lot on what your realtor says. And the real estate community, we'll talk a little bit about NAR during this. They have some idea of what's going on, but as an industry, no way. There's lots of suggestions coming out about what the real estate community should be doing as far as contract times, setting expectations, all these various things. But I think all the folks here who deal with realtors know that to change that animal quickly, not that they're animals, but that animal quickly, it's going to take a while. One of the when I mentioned about the one-word explanations or about TRID, one of them was blame game. And one of the first persons said blame game. Who's going to be blamed at the end when things don't go right? MLO, right? Mortgage company, mortgage broker, right? That's, so part of this is setting the stage. And I think setting the stage with the borrower is of utmost important first. Setting the stage, letting them understand stuff. Because realtors are going to be tugging them and pulling them to do what is in the best interest of them. But and then vis-a-vis the lender, ultimately responsible. Lender, the realtor has no skin in the game when it comes to accountability, liability, responsibility for any of this stuff. That dynamic is going to change, And today, if you think about it, settlement, the HUD-1 settlement statement, it's an attorney or a settlement agent's responsibility. This throws that regime out the door. It's all on the creditor. So once again, these are things to think about as we go. We talk about the closing disclosure quickly, just for time purposes, talking about timing and delivery. Creditor is responsible for ensuring that the consumer, the borrower, receives the closing disclosure no later than 3 specific business days before consummation. I would hope that everybody at this point knows that. How you prepare to get to that point, that 3-day point. Everybody today is preparing for the closing day. Now you're going to be preparing for 3 days before the closing day. So turn back your clocks and try to figure out how that impacts your workflow, your process, how you clear a file from underwriting or how your lender clears a file for underwriting. And then now we take a breather. We get this document out there and the borrower goes through their process. We talked about the idea of specific business days, which we're just mentioning here. That's for all practical purposes your rescission days. Okay, there's 2 different definitions of business days within this. I'm not going to go into that today. Hopefully you guys know that by now. But when would an additional 3-day waiting period be triggered? And that's if the disclosed APR becomes inaccurate by an eighth for a fixed rate or an ARM. There's this whole discussion of regular versus irregular transactions. It's not that all ARMs are irregular. In fact, most ARMs are regular transactions, which means it's an eighth trigger. Okay, which means after you've issued that CD, if something changes and your APR goes up by an eighth, got to reissue and wait 3 more days. If the loan product changes, there's a specific definition of loan product in there. So likelihood of at the very end of a transaction, the borrower changing their loan program is probably pretty small for most folks, but it may happen. And the last one that would trigger a new 3-day waiting period is the prepayment penalty addition. And once again, I don't think we're in an area today where there's a lot of prepayment penalties being charged, if at all. But if they were, this would be another one. There are some considerations here that I'm not going to go through all of it, but just, to think about once again, what's the delivery mechanism going to be for this closing disclosure? Is it going to be electronic delivery? Is it going to be face-to-face? Is it going to be mail? I mean, there's references all over the rules about mailbox rule. It takes 3 days to get to the person, and then you got 3 days from there. How practical is it for you to deliver this even in person? It's impractical, So you really think that we're going to be going to an electronic delivery method for most folks. It really is the most practical way to do it. So that, the method of delivery is going to be important. Second bullet regarding who's preparing the CD. Like I said earlier, as far as we have heard from the industry, lenders are preparing CDs. They're not going to rely on the settlement agent when the lender has all the responsibility and liability. But maybe there'll be some outliers who have, systems set up where they can rely on their settlement agents to actually prepare. The term in the rule is consummation, not closing, and that means when the consumer becomes contractually obligated, which most cases when they sign the note, that's the trigger point. 3 days before that is when they have to have the CD. And then the last thing is kind of a throwaway, but not really, which is that the settlement agent must provide the seller with the closing disclosure. Lender does not have the responsibility. Settlement agent does. It's a different form. So you have 2 closing disclosures, a seller's version, buyer's version. They don't mix and match. Seller's not supposed to get the buyer's version, but most lenders will require both versions because they have to see the seller side as well. Quickly talking about coordination of the closing. Because of the 3 days, because of all the other things that we talked about, we definitely think it's going to take a lot more effort, a lot more upfront communication to coordinate the closing. And because of the shift in responsibility, it all has to flow through the lender. You know, the settlement agent is going to be a major participant, just like they are today. We don't expect that the lenders are going to take on the responsibility of calling for water and sewer per diems and homeowners association setup fees and getting, you know, the realtors' commission bills or the surveyor's bills. We don't expect that lenders are going to be gathering that. They're going to rely on the settlement agents and closing attorneys to still do that, but they're going to have to gather up all that information and then give it to the lender, so the lender then can prepare the closing disclosure. Talking about processors and communicating with realtors for changes to contracts, changes to earnest money, commissions, all those things that may impact the disclosures. And as I mentioned before, early communication with the borrowers. Closers, you know, for both brokers and lenders, communicating with the settlement agents early. You know, as I mentioned before, even the simple process is this an old transaction with a HUD-1 and a TIL, or is it a new transaction with a CD? You know, having to verify information, re-verify information, and so forth. Because once again, lender is ultimately responsible for 100% accuracy of the information that's being disclosed. I don't know if there's any settlement agents in the room, but you know, once again, trying to figure out across each lender, what's their process going to be? Is there going to be a portal? Is it going to be a collaborative, you know, a collaborative type of process? You know, do you have to scan and send every bill? You know, how's that going to work? It's going to be a fax, you know, things like that. There's going to be a lot of moving parts there. And I trust that nobody will be ready to answer all those questions on October 3rd. But you figure by the end of the month, you're going to start having your TRID closings. So while October 3rd, the focus may be, you know, does LOS work? Can we originate a loan? Is our website operating properly? All those things. Within a couple weeks, depending on how quick your processing is and what happens with the transactions, purchases versus refinances, figure by mid to late October, you're going to start having these TRID closings coming. And you know, what's that going to be like? Don't have any answers there, really, don't know. But a lot to think about for certain, CFPB published a closing fact sheet June 4th. If you haven't seen it, it's a good one-pager. You know, kind of at the point was used to quell some of the fear that was coming out of the presentations and the webinars and so forth, where people were concerned about, primarily about the 3 days and the closing disclosure and the redisclosure and what's going to trigger this new 3 days, and am I ever going to get to closing because I got another 3 days, because things keep changing. And I think it's a good, you know, once again, it's available on the CFP website. It's a good kind of primer for, you know, quelling those fears, especially with the realtors and also with the borrowers. Only, as I mentioned before, three specific instances that once the CD is issued that you have to reissue another one and then wait 3 days. You don't have to make changes, but you don't have to wait 3 days unless one of those three things is actually triggered. And that's the rest of this too. This all talked about that, which is, once again, that was feedback from industry about that stuff. So we mentioned before about, you know, industry communication, and the NAR definitely had some stuff that was published. The NAR participated in some of the, the MBA webinars and the other, shows and stuff like that, where they're talking about it from their perspective and so forth. So these are some of the things that came out. You know, what were realtors saying? You know, that buyers should not expect to make changes at closing. Sellers should not do anything that require changes at closing. And then also setting realistic expectations about the processing time and about the time from, writing your contract and so forth. And then there's some specific stuff from the NAR, and I'm not going to go through these things, but, once again, unified front, trying to realize that, this is going to be tough times for folks, and that, the realtors are an essential part of it, and that, we'll see what happens. Really mentioning here in the second bullet, realtors are not liable for anything under TRID. So, they're going to push, they're going to do what they've got to do to try to get their closings done. But I think that if the lending community is unified up front and kind of says, this is the way it's got to be, I think it will help. I think when you have lenders that are, let's just say, folding under the pressure and so forth, I think it's going to make it difficult for everybody else. So I think that's one of the things. And it's harder. I think the NAR is a very unified group. I think the MBA and the other trade organizations in mortgage banking are definitely more diverse and dispersed, and it's not as unified. So I think that there's going to be challenges with that. And there will also be, as there are with everything, people that push the envelope on certain things. And that's going to make it difficult and challenging as well, in the marketplace. So From REMN Wholesale, TRID for Dum-Dums, and this is also available at the booth there. The company has done, I don't know, 7 or so webinars that are available, on TRID. And we started doing this, I don't know, about 8 months ago with the webinars, trying just a slow flow of information, so that people had the basics. And even with that, like I said, having been down in DC, the amount of questions was enormous. The amount of uncertainty was enormous. The words that were used, like I said, the one words, we started with blame game, and there was everything from, anxiety, anger, confusion, cluster, fill in the blank afterwards. I'm a little bit disappointed to say there was not one person on the panel. So this was about, let's just say 25 folks, firms, DC firms, industry participants. There was not one single person who had a positive word to say about it. And that's kind of disappointing, but it's the reality of where we are. So, in closing, I'd just like to say, it's an important, couple weeks, important year, a couple years. There's a lot going on here. And I thank you for your time.
This is Mortgage News Network.